Hi, this is Leslie Hernandez. My partners are Saul Mendoza and Jonathan Smith, and today we're going to be presenting on the WorldCom scandal. So WorldCom began in 1983 as a telecommunications company which provided long-distance phone services. The company was founded by Bernie Ebbers, Bill Fields, David Singleton, and Murray Waldron. And this company went public in 1989 through the acquisition of Advantage Companies Incorporation. And there were three divisions. So there was the MCI WorldCom, which included US telecommunications. There was the UUNet WorldCom, which provided internet and technology services, and WorldCom International. So for the next decade, WorldCom continued to grow itself into the second largest long-distance telecommunications company in the United States, and they did this by acquiring and merging with multiple companies. And in 1998, WorldCom's merger with MCI Communications was worth $40 billion, and this was WorldCom's largest and most successful merger. Now we're going to be talking about the Telecommunications Act. So this act played a vital role in WorldCom's success as it facilitated entry into the market. And this act was passed by Congress on February 1st, 1996. Its purpose was to allow smaller companies to compete with big companies like AT&T, for example. And this act impacted local and long-distance telephone service, cable programming, and other video services such as broadcasts and educational services. It was meant to deregulate the industry and provide organic competition within the telecommunications market. So some of the key players in this accounting scandal were Bernard Ebbers, which was the founder and CEO in 1985. He then was forced to resign in 2002. And there's also Scott Sullivan, who is the Chief Financial Officer and Secretary of WorldCom. David Myers, who was the Controller and Senior Vice President of WorldCom. Jack Grubman, who was the Wall Street analyst who had a close relationship with top WorldCom executives, and Cynthia Cooper, who was actually the chief internal auditor that broke down WorldCom's fraud. So what happened? WorldCom became successful by purchasing regional competitors using its own stock. And from 1988 to 1994, WorldCom had acquired 30 companies and sales were nearly $1 billion. A sudden decline in the tech industry caused WorldCom's profits to suffer as many companies cut their telecom services. WorldCom executives refused to accept this reality, and so they therefore turned into committing fraud, and they lied on accounting statements. Internal auditor Cynthia Cooper was able to uncover the wrongdoings, and this case went down as one of the largest accounting scandals in history. Thank you. Now I will be passing it on to Jonathan.
Thanks, Leslie. So next we will look at how this happened. In 1999, WorldCom's revenue was on a decline. They were about to release their quarterly earnings, and David Myers mentioned to Scott Sullivan that the numbers were down. Revenue was down for the quarter. And Scott Sullivan simply said that these results were unacceptable. He told David Myers to go back, look at the numbers again. There had to be a mistake somewhere, and to fix the mistake. So David Myers went back, checked the books again. There was no mistake. And Mr. Sullivan advised David Myers to book a fake entry to bolster the earnings. Now, David Myers was not new at this. He knew the numbers were what they were, and he knew that by booking a fake entry, what he would be doing would be wrong. David Myers worked at EY as a manager before working at WorldCom, and eventually he decided to book the fake entry under his boss's recommendation. The fake entry that WorldCom ended up using was known as prepaid capacity, which upon the audit of WorldCom, nobody had ever heard of. This was the fake term that they used to increase their earnings. And the thought that Scott Sullivan had was that they would make this mistake to hide the losses in one quarter, and then in the next quarter, they would just do the opposite and everything would be fine. Earnings would be back to what they had always been and everything would be good. Unfortunately, earnings were not good in the next quarter and they ended up doing the same thing as before, which is booking the fake entry. Essentially what WorldCom was doing is they were capitalizing their expenses. Now, any basic accounting student will tell you that expenses cannot be capitalized. They're not an asset. So they must be booked as expenses. They are not allowed to be capitalized. And this is something that everyone at WorldCom should have known and more than likely did know. This was not a very sophisticated or complicated scheme. It was simply, like I said, booking an expense as an asset to hide losses for the quarter. When things didn't change in the next quarter, they did the same thing. And then they ended up doing this over 5 quarters and they overstated their earnings by $3.8 billion. Now, another key player in this whole scandal was Jack Grubman. He was the Wall Street analyst that had worked very closely with Bernie Ebbers and WorldCom. In fact, after the Telecommunications Act, Jack Grubman was the person who negotiated all these deals and mergers, which made WorldCom what they were, which was one of the leaders in telecommunications. Grubman worked at AT&T before moving to another investment firm, and basically he was the go-to analyst for WorldCom. However, once there was an investigation going on, he claimed that he did not have a close relationship with Bernie Ebbers or WorldCom. He was simply just working with them, although previously he had bragged to other analysts and people that he was very close with Mr. Ebbers and went to his wedding. And upon the review, he switched his story and said that he wasn't that close. And here we have a look at the timeline of how this all happened. And this happened very quickly. We see WorldCom, through the mergers and acquisitions after the Telecommunications Act was able to grow extremely fast, and their stock price closed at $64.50 in June 1999. By July of 2002, they had filed for bankruptcy after the scandal had been uncovered. And then next, Saul will talk about the line costs.
Thank you, Jonathan. Line costs, let me begin with how they worked at WorldCom. WorldCom rented the phone lines / towers, and with that, customers would pay to use their services, phone services. And the rental of this equipment was referred to as line costs. But when WorldCom started to lose money, they lied and overstated income by $95 billion, which they did because they capitalized expenses, which I will go into further in the next slide. GAAP. So as Jonathan said earlier, when WorldCom used creative accounting and capitalize on rental expenses, this implies that you take the expense and turn it into an asset. Obviously, we know from accounting and finance classes that an asset is basically an expenditure that will create a future economic benefit. However, in this case, there's no future economic benefit because they are being rented for phone lines and then using that period. WorldCom had a total of $3.8 billion worth of operating expenses as capital expenditures and overestimated for 5 quarters. And if the expense had been stated as ordinary expenses, it would have shown that the company would not be profiting, but instead losing money, as you can see on this graph, which is completely violating the matching principle, which calls for a match between revenue and expense that is booked on the books of record. and the expense misclassification violates the matching principle. Furthermore, another violation was the objectivity principle, which calls for when you book a journal entry or invoice for expense, you have to have supporting evidence. And when the company or the controller here booked a false entry, there was no support for that. This was an entry recommended by the CFO during the controller, so they violated the objectivity principle. And lastly, Cynthia Cooper, which is part of an internal audit team, she uncovered this fraud, as stated previously. And she was part of the team that looked into the bugs and realized what was happening. And as she got closer to the truth, she uncovered the whole scheme, what she found was that the company violated two accounting principles: objectivity principle and the matching principle. She reported it to the audit committee and the board of directors. Then things began to round from here. Consequences. So this led to the company filed for Chapter 11 bankruptcy in 2002. From there, the company and their main assets were acquired by MCI. And then later, a few years later, MCI was acquired by Verizon. Bernard Ebbers, CEO, was sentenced 25 years in prison. Scott Sullivan, 5 years. David Myers, controller, 1 year. 30,000 people lost their jobs and wreaked havoc on their retirement plans. And lastly, we'll talk about Sarbanes-Oxley Act, which strengthened disclosure requirement and the penalties for fraudulent accounting in the aftermath of WorldCom. WorldCom left a stain on the reputation of accounting firms, investment banks, and credit rating agencies. The act implemented new rules for corporations, such as setting new auditor standards to reduce conflicts of interest and transferring responsibility for the complete and accurate handling of financial reports. To deter fraud and misappropriation of corporate assets, the act imposes harsher penalties for violators. To increase transparency, the act enhanced disclosure requirements, such as disclosing material, off-balance sheet arrangements. On behalf of Leslie, Jonathan, and myself, thank you for watching the video. If you want more information, we'll have some links in the description, so check them out. Thank you. Have a good day.